Hey everybody, what is going on? I know you're excited here. You want to know why? We got a stock market lessons video today. I know you guys love learning, and that's what I'm here for. Today we're talking about different order types. Now, again, may seem like a very basic concept, but there's a lot of different order types out there. I mean, it's not a massive amount, obviously, but knowing when to utilize certain order types definitely can make you make more money in the market, right? If you know how to utilize order types and really just work it that way, it's going to be fantastic for you, right? It's something you might need to know instead of just using, look, all of us just basically, some of you, I know when I started out, I didn't care. I didn't even look at any sort of order type. I just hit send, right? I don't give a crap what it was. It's not the play, gentlemen, okay? Ladies and gentlemen. So, without further ado, let's get right on freaking into this thing. And don't mind my awful organization. I had to pivot, unfortunately, to Paint 3D for this instead of my usual Sketchpad. So I have to do this. It's fine. So our first order type and the most basic one being a market order. Now this is what you and I typically as an investor probably do by default. It's usually the default order type, uh, especially on a lot of platforms. If you don't know what you're doing, it just will by default be a market order and basically just means it's going to execute right away. That's what you're used to probably, right? You have an order, you place it, it buys or sells the stock right away. Probably what a lot of you are used to. I know when I started off on platforms like Robinhood, it certainly was the case. You'd place an order, it would get filled right away, and you're like, oh, that makes sense. That's just how the market works. Not necessarily, right? So that's a specific order type. Now, with that, it is a market order. And basically, all that means is you're going to be getting the next available market price for this one, right? So you will get the next price available, the next best price available to you, basically matched up by a market maker. Now, again, all these market makers nowadays on most stocks, you're going to be talking about a computer that does this. It's going to link your order up to someone else's order. So if you're buying it, you're linking to someone that's selling it. So they're going to get the money from those proceeds, and you are going to get obviously the stock if you're buying it, and vice versa if you're selling it. Now, what the heck does that even freaking mean? Next available price? Well, some of you, and I know most of you, similar to what I might even feel, is you might just look at this and you're saying, well, this is the price I'm getting, 181.11. But that's not necessarily the price you're getting, right? It's something you need to consider is whether you are buying or selling. So when you're placing a market order, and really just in general when you buy and sell stock, you're going to be a lot more concerned with this over here, your bid and ask, right? So basically, just for your for you to know there, the bid price is where you're going to sell the stock at. So you'll notice, obviously, the ask is always going to be a little bit higher. So you're going to be selling the stock here. In this case, just have Apple up here at 181.10 in the hypothetical scenario. But then you look at it and you say, well, that doesn't make sense. I'm losing 1 penny per share here compared to what the going rate is. Well, yes, and the reason for that being is they refer to that as the spread. Okay, um, let me just see what kind of work we can do with the mouse here. Most of it I typed out, but so this right here is the spread, the difference between the bid and the ask. Now you'll notice with Apple, it's a very, very small spread. We're talking 1 penny. You get into your stocks that don't necessarily trade the volume quite like Apple. I mean, you look at this, nearly 62 million shares traded place here just on Friday, right? That's a lot. So with that, your bid and ask, it's so much easier to match up orders that spread is a lot smaller. Basically, that spread just means that the market maker, in this case, usually a computer, they get whatever that difference is, right? Because they got to make their money somehow. So to match up the order, they're basically taking 1 cent of each share. And that's really what they make in terms of their money. That's how they make their money. So that spread, which obviously isn't bad on some stocks like this, but that would be what you need to consider, right? Your bid is where you're selling it at. Your ask is where you want to buy it. If you wanted to buy 100 shares of Apple right now, you know what you got to pay? $181.11. Okay, that's what you got to buy. That's what you got to pay for it. If you wanted to sell it right after that, you know what you're going to sell it for? 181 10. So you're going to immediately lose out on, 1 cent a share, $1, not crazy. But it's worth noting because some people look at it like, well, maybe it's infinite money. You buy it at the 181.10 and then you sell it at the 181.11. I've had plenty of people say that, well, the ask is, what someone's asking to buy it from you for. No, it doesn't work that way, folks. It doesn't work that way. Bid, sell, ask, buy. Just think of it that way. So that's how the market orders work, okay? You're just basically going to get usually whatever this price is listed here. If you're selling it, you'll usually get what the bid price is. There are exceptions, and it depends on how many shares you're buying or selling, right? So that is worth noting. So you might not necessarily get that, but you'll probably get pretty close to it if you're trading a stock that's relatively heavily traded, right? But it does depend. You need to consider that. Finally, the last little other facet there of market, which most people don't touch this. I've never touched it in my life because I don't necessarily find the use for it, is a market on close order. Now, a market on close order, you see as it's underlined there, basically is just referring to the fact that you're going to submit your order and then 5 minutes before the market closes, so 2:55 Central, whatever time zone you're in, obviously, 5 minutes before the market closes, this order is going to go ahead and execute as a generic market order, so whatever the price is at the time. Look, and I understand the use case. I don't necessarily, I mean, I get it. You expect maybe the stock to be a little bit cheaper before the close. The trading activity ramps up quite a bit before close too, so that's worth noting. I just personally, I've never found a use for a market on close order. I'm not maybe that advanced. Some people probably have a good strategy with it, right? And maybe it's with day trading. Maybe there's probably a reason people have this, okay? Let's move on to the next order type here, which is one that's, a pretty enjoyable one, and that's going to be your limit order. What the freak? Anyways, so let me just bring this back up because for some reason it disappeared. So what is a limit order? I didn't capitalize it, don't worry. So a limit order is going to be, as detailed here, you are going to be selling a stock for your price or better. What does that mean? So that means you are going to specify a price. So we look in the hypothetical scenario again, where, where did my mouse even go? So hypothetically, we're looking at Apple. Let's just say you bought the stock at, $180. You're happy with that, right? You like it at 180. And the going rate is 181.10, right? And you don't want to sell it for 181.10. You basically want to go ahead and say, well, once Apple reaches a certain price, I want to sell it. So let's say that price is just 200, right? So let's say you want your 100, you bought it for 180, you want to sell it for 200. So that's more than possible here with this limit order. So what you do is you put a limit order to sell above the market price. So that's what's really important to note here. So if you're doing a limit order and you're selling, you do it above the market price. So just detail that here. Sell is going to be above the market. Look at that. The reason being, well, if you put it under the market price, you can't necessarily guarantee what that fill price might be, and it's going to be, obviously, you might get less than you want for it, just to be honest. So the good thing to note with one of these limits is you are guaranteed to get, you're going to get your price or better. So in this case, our scenario of 200, if Apple reaches 200, you are going to get $200 or better per share. Now I say or better because stocks can move pretty quickly, right? There is a chance that by the time you're looking to sell your 200 and your order kicks in, the stock might have moved up another 10 cents, 15 cents. So you could end up selling it for higher than $200. The main point of the limit order means you are not going to get anything less than $200 per share, or in this case, the price you specify, right? That's basically a way that you can lock in a gain that you like, right, if the stock reaches that price. Because with market orders, obviously there's volatility, and you can't know for sure what price that's going to get at or what it's going to execute at. So that's what matters here. So with a limit, you can basically take the guessing game out of the way and specify that. Now, there is also the way to do a buy limit. So what do you do with a buy limit? Basically the inverse of your sell limit. So if you want to buy something, it's going to be below the market. So hypothetically, you look at Apple. Let's just say once more, the going rate here. Let me just flip obviously my colors here. Oh, well, forget that happened. If I erase it, I bet it's gonna do this nonsense, isn't it? Yeah. Anyways, forget that ugliness that I just did there. Just forget that. So let's say instead in this scenario, you want to buy Apple at a price of $160, right? So 160 looks like a cloud what I did there. You're saying, well, I think Apple's too high. I don't want to buy it at this price. I do want Apple stock eventually. I just don't want to buy it right now. That's going to be, yet again, a limit order. But you can put it below the market price. And what that means, yet again, is if that price of Apple goes down to $160, you are going to buy that stock at $160 or better. Now, in this case, the better means lower than. So that means you could potentially get it for less than $160. All you're doing with the limit order, you're specifying saying, I will not pay more than $160 for Apple stock. That's what's going to happen. Now again, you might need to notice there is a chance you may never reach that price, right? It's 100% a possibility you don't reach that price. And that is where we get into kind of the next little bit of limit orders. Is more of a general order type too. It's available with all the other orders coming up here as well. It's going to be a day versus a good till cancel order. Now, a day order is exactly what you think it is. So basically at market close or the end of the day, it expires, right? Um, just like the bread I always have on the counter. I mean, that thing goes bad in a couple days, I swear to you. Some things, I'm telling you, they last past the expiration. When I have bread on my counter, it goes bad at the date of. I mean, there's mold on it the day of. What's going on here in the air I'm breathing? Something's not right. Something's not right. I've been told I should put it in the fridge. So, anyways, when the market closes, your order expires. Meaning, if Apple, in this case, or your stock did not reach the price that you wanted it at, that you wanted to buy it, or that you wanted to sell it at, the order just expires, right? And you can just try the same old rigmarole tomorrow if you wanted. Now, the good option, a great option or opportunity here is a GTC order. That meaning a good until canceled. It is exactly what you think it is. The order is simply going to stay open as long as you want it to until you cancel it, or let's say, most brokerages, they have a limit on your good till cancels. We're talking like 6 months usually is what you'd see, because they don't just want you to have an order in through infinity. So normally it's closer to 6 months, but in hypothetically, a good till cancel order just means it's never going to expire. It just stays open until you cancel it or until the stock reaches that price. So in our scenario, let's just say Apple down the road, it reached $160 in 3 months. Because you had a good till cancel order that stayed open, you're still going to have your order out there as an open order, and you're going to buy the stock at $160. So you don't necessarily need to babysit the order and replace it every single day. That's what's great about the good till canceled. You place it, you don't need to babysit it, right? You just leave it open. If you know that's the price you want the stock at, boom, you're done. So that's a limit order. Definitely underutilized by a lot of people too, right? Because with a market order, you can't necessarily specify the price you want. Now with a limit, it's good because you can specify the price you want it, right? A lot of people don't necessarily utilize these. They just go with the market, and they could be missing out on, again, we're talking maybe it could be a couple cents a share, but if you're trading several hundred shares, right, this is actually relevant depending on how much you trade. It's pretty important. So yeah, limit orders underutilized for sure. Our next order, pretty basic. It's going to be a stop order, right? So what the heck are we talking about a stop order? Look how you see how I put the little red in the background. It's like a stop sign, kind of. Let me just do that real quick. Ooh, that's terrible. That's terrible. Let's get a better stop sign in here. Okay. Do you like this? Do you like this? Ooh. Ooh, that's pretty bad. I guess I probably should have just drawn it around the word stop already. Wouldn't that have been smart? Anyways, while I'm doing this, stop order is, as I specify below here, protection. Now, basically, it is you are protecting yourself from, you know, from loss in this sense. So it works on both the upside and the downside, right? Most people will utilize stop order as a downside protection, basically meaning, once again, um, we bring up Apple one more time. As you know, I love to do it. I love talking about Apple. Apple right now trading at $180. And you basically you want to partake in the price. That was the weirdest 8 I've ever drawn. I somehow pivoted it and it didn't look terrible. Anyways, so you basically you want to partake in Apple moving upwards, but you also want to be safe. What you'll want to do is you're basically going to put out here and say, well, I still want the stock to go up necessarily. I don't want to necessarily sell it. But in this case, I just want to say if I see that the stock is trending downward, let's say it's trending down to 150, right? That's basically my stop price. I want to be out. If the stock's tanking, I want this stock to be done at 150. Just get it off my hands because I don't want to partake in potential more downward movement. Now, the reason you utilize this, again, is for protection, right? So usually when you use it, with it being protection, is let's just say that you, in this scenario, your actually cost basis on Apple. So you actually purchased Apple at, let's say you're in at Apple at $100 a share, which is impressive. I mean, obviously you've been in before the split, so that's the worst thing I've ever drawn in my life. So you're in an Apple in $100 a share, and you're up massive, right? We're talking about the stock has appreciated to $180. And now you're basically saying, look, just on the off chance, I don't want to even have to risk it going down. Or I should say, I don't want to have to risk that the stock could go back down to my cost basis and I could lose money. I want to guarantee myself that I'm going to make a profit on this one. I want to be sure. So even if things go sour and the stock starts going down, I want to make sure I get a profit. So that's why you set the stop at 150. And what's that going to mean is once that price, this is your activation price, right? Let's just do that, ACT, with a period there. Activation price. What that means is when the stock reaches 150, your order will turn into a market order, right? So what that means is, hypothetically, let's just talk about how ticker, or the ticker tape works here. So let's just say, we have a price, then boom, it hits 150. So now your stock, or I guess in this case, your order is activated at 150. So then it takes 1 tick, 2 ticks, and then it's going to fill here, right? So there is a chance with a stop order, you're not going to guarantee that you're going to get necessarily 150 a share. So the scary part here is, the stock could be free falling. It can hit the activation price, and then even in 2 ticks, the stock might be trading for $145 a share. Very rare, right, with a stock like Apple, but with your lesser traded stocks, it's definitely a possibility. So that's a difficulty of these stop orders. And for that, that's why they create a stop limit order. So let's just say this also exists, right? A stop limit. And what does that mean? So same scenario as before. You're going to put it at $150. The stock's trading at 180. You put your stop limit at 150. Now there's one extra qualifier to a stop limit. You're not only going to set the activation price, but you're also going to set a limit price. So the activation price is going to be at 150, and then what you're going to say is, well, if it drops past 150, I want to sell it for no less than 148, just on the off chance that it did fall like this. So if it did, right, in the scenario we have over here, if this did come true and it hit the activation at 150, and then the next time, by the time your limit order was in action, if the stock price was 145, it's not going to sell the stock because you set your limit at 148. You're not going to sell it at less than 148. So now basically you'll have an open limit sell order at 148. So if the stock goes up to 148, it's going to sell. Now you may be saying, look, this kind of gets you in a tricky spot here, right? It could potentially be a tricky spot. And there's no doubt about it, right? That could be dangerous because you may get yourself stuck in a trade that you wanted to get out of that you're kind of stuck on now because of the stop limit, right? I completely get that. I don't typically use a stop limit much. It's very rare. Now, one place that people do utilize it that isn't specified here is actually going to be on, let's just segment ourselves out a little bit here. So let's say short selling. I don't partake in it much. It's very, very rare for me. Let's say you are short stock. And obviously, if you don't know what that means, it means you're borrowing the stock. What you want is for the stock price to continue to go down. So you're borrowing a stock price or a stock at a certain price. You want the stock price to go down, and then you buy the stock back and give it back to whoever you borrowed it from. But you bought it for a lower price, and they paid you a higher price. So that's how you make money. So with a short stop or when you're short stock, a stop order is used above the market price. So what that basically means is it's a protection just in case the stock keeps going up. You don't want to buy it back at a higher price because that doesn't make sense. You borrowed the stock at a certain price. You don't want to pay a higher price for the stock and then give it back at that lower price. You're just losing money. So with a stop order, you can basically say, all right, it's happened, right? I shorted the stock. I basically want to make sure that it doesn't just absolutely skyrocket on me and I end up paying way too much to give the stock back. So you put a stop order in place. What it's going to do is it's going to go ahead and, buy the stock. Once it reaches that activation price, it's going to buy the stock back. That way you can cover your short position and not have to worry about necessarily getting screwed over by a big rally or something like that. So that's where you would utilize this. So a couple different use cases for a stop. Same exact thing for a stop limit whenever you're looking at short stock. So that's basically your stop orders in general. That's great. We have one final order to bring, and it's going to be a very, a lot more advanced of an order here. And the reason why I put advanced protection here. So this is a trailing stop. And the real key word here, this is advanced protection, but the key word is going to be this word trailing. What the? Okay, there we go. This word trailing. So another word for trailing, just think of it this way, following. So you're going to place an order out there with a stop price, but your stop price is going to follow the stock. Now, this one is always best to be explained. It's a tough order type, right? It's tough to really grasp. So basic, generic, thing to say here. You do it in either a dollar amount or a percentage. So if the stock goes down a dollar amount or goes down a certain percentage, it's going to sell the stock, right? Similar to a stop order, same exact premise there. So if it goes down a certain dollar amount or a certain percentage, it's going to sell the stock for you. Now, the reason it's advanced is because of this word trailing here, right? So this one follows the stock. The reason this is a great order type is because you can partake in the upward movement of a stock, and these trailing prices that you specify, they follow, okay? So I'll give you a couple scenarios here. We'll give Apple, but first we'll just draw a generic chart of what it looks like. So let's just say, hypothetically, you've put a trailing stop at 5%. Let's say if this stock falls 5%, you're going to sell the stock. So here's, hypothetically, we draw the stock price here. It's trading around this level, right? Trading around this level. It breaks out, and then it does a little bit of this, and then it ends up dying off. So with it being a trailing stop, and we set it at 5% below, it's going to do exactly what you think there. So whatever the upper limit is here, so the high price, boom, it's going to follow that. And it's going to go from 5% from that upper limit. So even down here, you see your upper price right here. So let's just draw what this looks like. Your limit is going to be 5% below. So it's just going to, in a straight line, follow over. And then, hey, the stock keeps going up. There's new high prices. What's going to happen is it's going to follow it all the way up until it reaches 5% below that, which let's just say it did in this case, right? That's the high it reached. And now the new trailing stop that you set is 5% below this high, right? So you can partake in the upward movement. The limit doesn't just stay down here, right? It's not going to stay down there. It's going to follow the stock upward. And then now your new 5% is right here. It doesn't follow the stock downward. It only follows it upward. That's why it's stopped, so it doesn't follow it downward. So if the stock goes up, your stop price actually goes up too. So now, instead of risking this downward movement, you've sold the stock right here, right? You're selling the stock right freaking here. So, you bought in back here, right? You put your order in and you bought back here. So now you've been able to get the stock to go up and you sold it at a much higher price because you put in a trailing stop order. So you partook in the upward movement of the stock. Now let's get a scenario here to make it a little bit, maybe a little bit easier to follow. The chart is definitely the best way to follow it, right? Looking at a graph of it actually in existence. It's a super complex order type when you don't know anything about them. Once again, I'll bring Apple into things as I always do. Oh no, what have I done? There we go. Apple stock. So I bought Apple. Let's do simple numbers. I bought Apple at $150. I set a trailing stop at a $5 trailing stop. Let's just do it simple that way because the percentages, then we'll have to bust out the calci. We don't want to do that. So if it goes down $5, we're going to sell it in this case. So let's just say, hypothetically, Apple doesn't go down $5. Let's say it actually goes up, right? So Apple goes up to 180 where it's trading at right now. Now my trailing stop is still in effect. So what does that mean? So now my trailing stop is going to be at 175. So if the stock goes down $5 to 175 from its high point, which is 180, I'm going to sell it for 175 instead of selling it for 145 in your previous scenario, right? At 150, it would have sold for 145. But with a trailing stop, it follows the stock upward, as you see in this chart here, right? This is the big thing there. It's basically like a shadow following you. I mean, it's a good way to think of it, right? The shadow's following you to a certain extent. It's a really good order type to use, basically because you don't have to babysit a stock anymore, right? You're going to set your thing, your price out there. You're saying, well, look, stock falls 5%. I want to be out of this thing. That just is what it is. But you're not limiting yourself to your upside potential. In a normal stop order, your stop price doesn't change. It just stays at whatever you set it at. With this one, it lets you participate in upward movement, as we mentioned, and it still creates that downward limit for you, that downward price, where it's going to automatically take care of the order for you and not have to worry about you babysitting or placing an order. So it happens a lot. They refer to one of these patterns here as a head and shoulders, right? So you see a breakout here. You're kind of hovering normal, and then it breaks out, and then it dips right back down to make that other shoulder. Usually this being a downward sign. Now with this trailing stop, you know what? You know what happens here? Well, we're gonna boom, sit around there, do that, and then our new limit is going to be right there. So instead of worrying about this giant downward movement here, we've sold the stock out earlier because we saw this pattern, the head and shoulders pattern. We knew it was going to happen. So we got our gain on the stock, and didn't have to worry about freaking out about this stock tanking. So, not really a better way to explain it there. It's good to get experience with something like a trailing stop. So, some simulated trading, something like that. It's a very complex order type, but it's essential to know how to utilize them because you can obviously make a lot of money using them. With that being said here, look, those are kind of our main order types here, and it's worth knowing what they do. So that's why we specify them. Anything else you guys are interested in knowing, please let me know. I hope this video gets some traction. Share it out there for people who might need to know it, right? This is important stuff. And I hope I get some traction here. People are viewing this. Give it a nice like, okay? We need people to know this stuff. That being said, I appreciate you watching. Hope you have a fantastic rest of your day. Sorry, we're a little drier this time than usual, but that's okay. Sometimes you get dry. You don't necessarily need to talk about the humorous things. And I'm gonna sneeze as we speak, so